Charlie Munger, my partner, and I, in 54 years now, we've never made a decision based on an economic prediction. We make business predictions about what individual businesses will do over time, and we compare that to what we have to pay for them.
Markets all around the world are falling on the back of a number of issues, including the conflict in the Ukraine, record inflation, surging oil prices, and the tightening of monetary policy through higher interest rates. The US market is now down 13% from its high set last year, with the Nasdaq down a whopping 20%, and the Australian market also down significantly, about 7%. And all of this has meant that the number of investment opportunities that offer great long-term returns has increased significantly. So today I want to talk about how you can identify some of these opportunities and improve the returns in your portfolio, particularly over the next year. Why should you listen to me? Well, first of all, you should take in a number of opinions from a lot of different people and form your own idea of how you want to approach the markets based on different investing strategies from different investors. But in my perspective, I made a 50% return the last time the stock market crashed in 2020, and over the past 4 years, my portfolio has averaged well over 20% per year compounded. Before I jump into talking about the actual strategy that I use to invest in the markets during a crash, but also just generally how I approach the markets, I want to talk about market timing, and it's critical that at this moment you don't fall into the trap of trying to predict when the market has reached a bottom. There is nobody in existence who over the long term can successfully predict where the top and bottom of the stock market is, even if you have all of the data available to you. There's not even a computer that can do this, and the reason why is because we live in a world where unpredictable events happen, whether it's just in the world generally, things like the pandemic and the war, or things happening in the economy specifically, such as inflation. These things are unpredictable, and even if you could have predicted some of these things were going to happen, it would have been impossible for you to know how and when the market would react to these things, because it doesn't always line up one for one, where as soon as an event happens, the market collapses. Sometimes an event happens and it takes a while for the market to collapse. Sometimes the market doesn't react in a negative way to negative news. The good thing is you don't actually need to know when the market is going to bottom, because all you need to do is buy great companies at a price that is low relative to the company's future cash flows. If you can do that, it doesn't matter if the stock falls another 50% after you buy it. I've been taking this approach with Netflix stock this week. I added it to my portfolio for the first time, and I have no idea how low Netflix stock will go. It could drop another 50%, it could drop another 70%. I have no idea, but what I do know is it's a great company, and based on my assessment of its future cash flows, I think that the price that I purchased it at was going to deliver, or is going to deliver me, a decent return over the long term. And the truth is, I still have cash in my portfolio, so not only do I not know where the bottom is for Netflix stock, I would actually prefer if the stock continued to fall. To a lot of people, this is backwards logic. Why would I want the stock to fall further when I've already put some money into the stock? And the reason why is because I haven't finished investing, right? For the vast majority of people who are watching this video, you will have 20, 30, maybe even more years of investing in front of you, which means you're going to be a net buyer. You're going to be mostly buying, not selling, of stocks over the next 10, 20, 30, maybe even longer years. And if you think of it from that perspective, then if you're a net buyer, you want to be buying stocks at the cheapest price possible. So in an ideal world, the stock market would be down significantly. Everything would be incredibly undervalued. The market would be mispricing everything significantly on the downside for many years, so that we can continue to accumulate ownership in great companies at low prices. And if you're wondering, well, if you want the stock to go lower, why did you invest in Netflix in the first place? Well, I don't know where the market is going to go. I don't know what price the market is going to offer me Netflix at tomorrow. I have no idea. I can only look at what is being offered today. And today, I think it's a pretty good deal, but if it offers me a lower price tomorrow or next week or the next month, then I will happily take that deal as well. I'll go a little bit deeper on how I'm actually approaching buying stocks at the moment a little bit later in today's video, but first I want to talk about what is my strategy for investing during a market collapse, and it's actually the exact same strategy that I use across time, regardless of economic conditions. Just the way that I approach it tends to differ depending if the market is really cheap or whether it's overvalued. I use Warren Buffett and Charlie Munger style value investing. And contrary to what a lot of people believe about value investing, this doesn't mean I'm necessarily looking for low price to earnings ratio companies or businesses trading below book value. Modern Warren Buffett value investing is finding great companies and buying them at prices below their intrinsic value. And that can be broken down into 4 key pillars: circle of competence, economic moat, management, and valuation. Starting with circle of competence means that we need to invest in businesses that we deeply understand. And for the average person, this means you want to start in a couple of key areas. Either areas you have a passion about, so if you're really passionate about consumer tech, for example, then maybe you want to look at companies related to that. You can also look at areas that are related to your hobbies, so areas where you're a consumer, so you're buying those products and services regularly and you kind of have an inside consumer idea of how those markets function. And then the other place you can look is your career. So if you've worked in a number of different fields, or even if you've just worked in one field, you'll probably have an idea of how that business works, at least at a basic level, more than someone who hasn't worked in that field. I think for me, I've found a nice cross-section between areas that are easy to understand, businesses that don't have too many moving parts. So restaurants, for example, is an area I've looked at because they're relatively simple businesses. A cross-section between simple businesses and areas I'm really excited about, because if you're not excited about an industry and a business, then you're not going to be willing to put in the work that is necessary to learn everything about the business and how it's likely to perform in the future. Every business we invest in then also has to have what Warren Buffett calls a wide economic moat, or an economic fortress, right? The idea here is that business is brutal, and if a business is making a lot of money, other businesses will look at that business and try and copy what it is doing. So the business that you're investing in has to have something unique that other businesses don't have that protects it from competition. If you imagine 3 or 4 different businesses selling the exact same product, then they're only going to be able to compete on the basis of price, and that means that there's no economic moat, there's no intrinsic protection, and each business will just slowly undercut each other until no business is making any profit. So you need to invest in a business that has something completely different, so that even when competition undercuts on price, consumers are still willing to pay more for that business's products or services. By the way, I've got videos breaking down each of these 4 pillars and then going even deeper into each section on my channel. I'll leave a link to the 4-step stock analysis playlist, which has about 15 videos in it, and it goes through the entire process in detail. So if you're wanting to hear more about these things, if you're wondering what kinds of economic moats exist in businesses and how do I identify them, then that is going to be the playlist you want to check out after this video. It's then not enough for a business to have an amazing product or service or some kind of intrinsic layer of protection. It also needs to be run by a great management team. And when we say great management team, we're really talking about 2 different things. One is honesty, integrity, and transparency, and the other thing is skill as a capital allocator and managing the financial health of the business. So on the integrity side, we want to invest in businesses where, first of all, the CEO and the management team care deeply about the business. So often I look for founder-run companies because naturally by that person creating the company, they're likely to be more passionate and more excited about the business than a different management team that's coming in and running a company. And you want to look for honesty when they're communicating with the shareholders. A lot of CEOs, a lot of executives will be kind of salesmen when they're talking to the investors. They're basically trying to hype up the stock and get people to invest more money rather than being honest about the challenges that the business is facing and how they're overcoming them. And then the management team doesn't just need to be honest and have values aligned with yours, they also have to be really good at their job, right? They have to be able to allocate capital within the business effectively and also keep the business in strong financial health. They need to keep debt to a low level so that if there is a recession, if there is some kind of problem going on in the business or the industry, they're going to be able to survive through that period without the risk of going bankrupt because they have these debts that they need to pay. And then once you've found a business that is one you understand, has a distinct competitive advantage, some kind of economic moat, and is run by a honest and skillful management team, you then need to do valuation, which is where it's not enough to invest in great companies. You need to figure out what are the likely cash flows that will come out of that business, the profits that can be delivered to shareholders over time. And you want to compare that to the price you're paying for the stock. Because at the end of the day, investing is just cash flow in 2 directions. It's outlaying cash, outlaying money when you invest in a business, and then expecting more money over time as that business produces profit and then delivers it to you. I have a number of videos going in detail how I do valuation and how I use my free stock analysis spreadsheet, which is also linked down in the description below, to make this process as easy as it can be, because it is very, very challenging. Links to everything you need to know is down in the description below. So once you have a couple of businesses on your watch list that you think are great companies and you have an idea about what price you're willing to pay, what do you do now? Well, first of all, in an ideal world, if you could find 5 to 8 amazing opportunities, great businesses at great prices, then you would want to invest in all of them and be 100% invested. The ideal capital allocation in your portfolio is to be completely invested in great companies that should deliver long-term returns. But in reality, these opportunities are very, very hard to find. They don't come around very often. Warren Buffett talks about having a punch card of 20 businesses that you invest in over your lifetime. So that essentially means that you should be expecting to find maybe less than one great opportunity per year. And in my experience over the past 5 years, that has really been the case. I've tended to find about one really good opportunity every year. And these aren't spread out evenly one each year. It depends on what market conditions are like. So leading up to 2020 and 2018, 2019, the market was relatively expensive and it was difficult for me to find opportunities. But then come March, April of 2020, I was able to find a couple of different businesses to invest in. And the same thing actually happened in 2021. The markets raced back up to well over where they were even before the pandemic. And again, it was hard for me to find opportunities. And in this circumstance, cash will naturally build up in your portfolio. I think a misconception is that people suggest that you have a certain percentage of cash in your portfolio. That is not how you should approach it. You want to be fully invested. The only reason you have cash in your portfolio is if you can't find investment opportunities, and cash is naturally building up because you're setting it aside from your income, so setting a percentage of your income to put into your portfolio, and from occasionally selling businesses in the portfolio that are no longer great companies. And this actually means that naturally, when the tides turn and markets start to get cheaper, you will naturally have cash in your portfolio that you can invest in businesses at appropriate prices. Just to give you an idea of how this looked for me during the last crash, in 2019, I was about 60% in cash, and this was a consequence of not finding any good opportunities during 2019 and cash coming from my income and going into my portfolio and building up to 60%. Then during about April, May of 2020, I was 90% invested with only 10% cash. So the turnaround was, and the difference between how much cash was in my portfolio was a consequence of the fact that there was no opportunities in 2019 and significant opportunities in early 2020. So where are we right now? Do I think we're in a cheap market? Are we still expensive? Well, I think we're coming down from expensive. Markets were insanely priced last year. I mean, I can't really tell broadly if the market is expensive, but at least the businesses that I'm looking at were very, very expensive. Now we're probably getting closer to fair value for the businesses that I'm looking at, and there are some investment opportunities. So even though the market broadly, I think, is not cheap, of course, as the markets come down, some businesses will be hit harder than others, and some stock prices will be hit harder than others, meaning there will be still more opportunities as markets get cheaper. You shouldn't really be looking at how the overall market is performing in order to invest in individual businesses, but it's just more common that as markets get cheaper broadly, if the market falls 50%, there will naturally be more individual opportunities. But if you can find a number of great opportunities in an expensive market, so cheap stocks in an expensive market, which does happen, then that's fine. You should be still looking at the individual business. And last year, for example, if I could have found 5 really great companies at cheap prices, I would have probably been fully invested, and that would have been fine. I wouldn't be investing right now. But because I couldn't find those opportunities then, I still have cash that I want to invest. And as markets come down, as they have over the past month, those opportunities are increasing. And if all of this sounds great, but you know you're the kind of person who's not going to dive into reading hundreds of pages of annual reports and learning everything about companies, that's completely fine. You can still participate in this falling market. The way you would do it is through dollar cost averaging into a US stock market index fund. So that means essentially picking a certain amount of your income that you're setting aside to invest and regularly invest it at regular intervals into the US market, regardless of what's happening. And if that's the case, if that's you, then this crash doesn't change your thinking on that. You still invest. If you're investing every single month into the into a US stock market index, for example, and that date is coming up, don't hold back just because the markets are falling and you think maybe it will fall a little bit more. Still make that investment regardless of what the markets are doing, and you're likely to do fairly well over time. If there's anything I spoke about in this video that you want to hear more in detail, then first of all, check out that 4-step stock analysis playlist. As I said, there's about 15 videos in there that are great for going through each of the steps in the process. But if there's anything that I haven't covered, even in those videos that you want me to go deeper on, then make sure you let me know down in the comment section below. But with that said, hope you guys have a great day, and I'll see you in the next video.